Welcome to the Money Business Podcast. I'm Neal Regino.
I am Brian Weyman.
This podcast, we're going to talk about investing, especially in a volatile market,
Which is good because over the past several months we've had a lot of questions about the markets and what was going on and all the hoopla, tariffs, and all the things that are making the market volatile, make it go up and down as quickly as it was. So let's talk about that. You started your career solely focused on investment, so why don't you talk a little bit about volatile markets?
yeah. I think I mentioned it in the first podcast. I started out in this industry at Vanguard, low cost indexing, and then moved my way to Merrill Lynch, and then came here in 2015 to Evolution Financial Group. So first of all, saying investing in a volatile market is just, we could just call it investing. The market's always volatile. The standard deviations or the amount of fluctuations have changed to be more dramatic, but it's always volatile. So we do get a lot of questions right now, especially with a lot going on with regulation changes, with what's going on with it, that this podcast, tariffs, things like that. There's always something that people are wondering, does it affect the market? Yes, of course it does. There's unlimited things that affect the market. A lot of economists will say, well, it's the underlying economy is going to drive the market, so just look at the economic indicators. Some technical analysts will look at trends, inverse yield curves, things like that, and say, well, we know when the market's going to drop. If you have the right plan, it's not going to matter. Well, the first thing I'll say is the market increases more than it drops. That's
True.
factual. We can see where the market started, where it's at now. It's always increased over time in a long enough period of
It's
time.
called growth.
Yep. I was just looking at an article on Morningstar that said there's been 20% drops or more in the last 150 years in the market. So it happens. But the realization is that the market is increasing more than it drops over time. So every time that there is a big correction, so I started my career in 2008. It was a fun time to start in this industry. And I remember talking to people that said, this time it's different. And I'm brand new to the industry, and I'm telling them it's not, but I'm also saying, well, as a professional, this is the first time I went through it. So is it different? And then you have to look at the historic data and the time since then, that every time people think it's different, the same thing happens, right? The market eventually goes back up. Sometimes it takes longer than others. I was reading another article that was, I believe it was Goldman, but I don't want to say exactly. But their analysis that they took said that it's about a 4-month time before the market starts to correct from a significant drop of 20% or more. Um, I don't know if that's necessarily true, and it depends on the data points that you hit, but it will come back. So the first thing I'll say about investing is, if you have the right plan in place, keep investing. So we talk about dollar cost averaging a lot in our industry. If you have the same monthly or same annual amount that you're saving, keep doing it no matter what. And what dollar cost averaging does is, you're going to buy the same amount at the same increment of time, whether the stock or the market is low or whether it's high. And over time, the thought is that you will average out to a lower price for that
sure.
investment than if you actually went out and tried to buy it on your own. Or tried to time the market, excuse me. So I'd say that's a big part of it. The second thing I'll say is, when a drop happens, if you do have cash on the sideline, or you've been thinking about, should I increase my 401k contributions or what I'm saving? Well, yeah, it's a great time to start doing that same thing, to start investing more when you're doing your dollar cost averaging, because ultimately the more you save, no matter what, at whatever time, you're going to end up having more longer term growth over time. So as far as savings is concerned, I say have the discipline. The hardest part of investing for the long term is the psychological test of when the market drops. Do I stay the course? It's a big part of what we do is handle the psychology
Yeah,
of
the
of
psychology is a
investing.
big deal because you see it. So many people will watch something on TV and they'll watch, Jim Cramer. Not that there's anything wrong with the people on TV, but they'll think because they're watching that they should be doing what they're saying, and then they try to time the market, and it just, I mean, it's the worst idea in the world to try to time it, right?
Yep.
It also, you also need to know who you are and what is your financial situation because like you said the market's always volatile, even when it's good it's volatile. So can you do you have money to sit on the sidelines and ride the waves up and down with the money that you're putting away without putting your financial picture at risk? I always tell a story. I was playing golf with a guy in a golf league, very nice guy, little kooky, and we're literally in the middle of playing golf, and he asked me if he should buy a specific stock. First of all, I said I'm not a stockbroker, so financial planner. But when he asked me, should I buy a specific stock, I said no. And he said, why? You don't think it's going to do good? And I said, I didn't say that. He said, why shouldn't I buy it? And I said, do you have any money? He said, some. I said, how much money do you have in the bank right now? He said, $3,000. I said, that's all the money you have? He says, all the money you have. He has. So no, you shouldn't buy the stock because it's all the money you have, right? So, that all comes down to it too when you're looking at somebody and trying to invest in the market. Where are you in life? How much risk can you take? And then how are you going to react, like you said, when the market drops?
Yep.
How are you going to handle that?
Well, I'm a guy who doesn't. I always say I don't believe in blanket advice. I am going to make some blanket statements right now. So,
Oh, no.
the first one is if you are going to invest in a stock, I believe that you shouldn't have more than 10% of your overall investable assets in one position. And that in general, that's not, when somebody, right now, a lot of people call us saying, I want to buy gold. And I say, that's okay. Here's where your portfolio is. Here's 10% of your portfolio. If you want to buy gold and that really fits into your overall picture, no problem. You can go buy it. Oh, I want to buy Apple stock. Well, if it's more than 10%, then let's talk about the risk you're taking. And it's not that they can't go more than 10%. It's that you're taking on more risk
Right.
the higher that you make your concentration. And then even the other way, where I've had clients that I've taken on as new clients and they have big positions in one company. Maybe they had a stock option plan. Maybe they held on to Microsoft for the last 40 years or longer than that, actually, the one that I'm thinking about, and it's ballooned up to be 60% of your portfolio. Well, how do we start working on taking that down so that it is less of a big exposure for your portfolio? So the second thing is I'll make a blanket statement on how to invest. So, I started at Vanguard. I love the company. I think as far as their investments, they keep the costs low. They give you exposure to a lot of different companies. So it diversifies your exposure to all of these companies depending on which fund you're in. And you'll have steady growth. I think it's a great way for a majority of people to accumulate wealth. And it's a great place to be in while you're building wealth. Once you get to a certain asset level, if you're comfortable with it, I believe you should have a portfolio manager managing your portfolio and making it less diversified as far as you might have a mutual fund or ETF that's got thousands of different stocks in it. Well, what if we have a portfolio manager that can take that down to 100, still reduce the overall risk of the portfolio and give you more upside potential? And something, I throw this quote out there all the time, but it's a Warren Buffett quote. And listen,
About diversification.
he is the guru in our industry. I don't think there's anybody who can argue that he knows what he's doing. He says diversification is an excuse for incompetence. I love that quote. Once you get to a certain asset level, maybe it's $1 million, maybe it's $2 million, maybe it's $500,000. It depends on you. It depends on your situation. But having somebody that's actually going to actively pick individual stocks and bonds probably makes sense. Again, blanket statement doesn't necessarily mean it works for everybody. But if I can show you somebody who does a portfolio analysis and says, here's your overall risk, here's your alpha, here's your beta, here's your standard deviation on your current portfolio that's in a diversified mutual fund or ETF portfolio. And if we change it to this portfolio that is individual stocks and bonds and it reduces the overall risk, still gives you the same, if not better, upside potential, then it might be worth moving. And again, it's up to the person who's the investor. But there's another quote that Warren Buffett says, which is $100,000 turning to $1 million takes work. Taking $1 million to 10 million is inevitable. And what he's saying is if you have the right fund manager and picking the right stocks, then it's inevitable that you're going to make more money. Now, again, there's no guarantees in this industry. So
No.
you could pick the wrong one and everything goes to zero. But that's part of what our job is to make sure that we line up our clients with the right fund managers that we know that have a historic track record, that are competent, and that our clients are comfortable with.
So the overall message really being that market's always volatile in one way or the other. It just depends on how you're looking at it.
And I actually think that the main message is this time is not different.
It's not. Right.
There's always going to be a new administration. There's always going to be new regulations. There's always going to be something that turns the market sideways. Wars, trade agreement, whatever it is. But it's not new. These are all things that we've been through before.
Right.
And it will always correct itself and come back, whether it's a 3-year period, a 2-year period, a 1-year period. The averages are there that it's not going to take a long time for it to come back. But I do just want to get that message across.
Yeah,
This
a horse of
time
a different color is still a horse.
Yeah, this time is not different. So,
All right.
Appreciate everybody tuning in, and see you at the next one.
We hope this helps. Have a great day.